Assalamualaikum warahmatullahi wabarakatuh. My name is Anissa Syaira binti Azizah Jasmi. My matric number is 069448. My group and I will present about corporate governance and bond rating in Malaysia. Corporate governance serves as the backbone of accountability in businesses. By fostering transparency, managing risk, and also aligning stakeholder interests, it ensures that corporations operate ethically and also efficiently. This concept gained prominence following the 1997 Asian financial crisis, a pivotal moment that highlighted the need for stronger checks and also balances. In Malaysia, key initiatives like the Malaysian Code on Corporate Governance and amendments to Bursa Malaysia listing requirement were introduced to rebuild trust and also enhance corporate accountability. On the other hand, the Malaysian bond market stands out as a dynamic component of the nation's financial sector. It offers a wide range of instruments including sukuk, asset-backed securities, and also fixed interest bond, providing opportunity for diverse investors. Supporting this ecosystem are credit rating agencies like RAM and also MARC, which play a vital role in assessing the creditworthiness of bond issuer. Bond ratings serve as essential tools guiding investors in evaluating risk and also potential returns. Research revealed some noteworthy findings in this space. Larger firms tend to achieve higher credit rating, benefiting from their operational efficiency and also financial stability. However, factors like board independence and also institutional ownership have shown limited influence on these ratings. Additionally, Malaysia's regulatory framework and the dual rules of banks significantly shape the bond market's dynamics. This discussion is not just academic, it has real-world implications. By exploring these aspects, we aim to provide valuable insight for policymakers striving to refine regulations, investors seeking informed decisions, and also corporate leaders aspiring to build more transparent and also resilient financial ecosystem. Together, this effort contribute to Malaysia's long-term economic stability and also growth. Thank you.
My name is Nurisma Farisa Alia binti Muhammad Yusha and my number matric is 069098. Let's begin by discussing the role of corporate governance in determining a firm's credit rating. Corporate governance play a crucial role in shaping a company's reputation and financial credibility. It affects how investors view the firm's risk and return potential, which in turn influence its credit rating. Now, corporate governance include key mechanisms like independent directorship and blockholder ownership. Independent directors are expected to enhance decision making by reducing management risk, providing oversight, and ensuring that management acts in the best interest of shareholders and bondholders. Blockholders, on the other hand, are shareholders who own more than 5% of the company's share. They act as external governance agent by monitoring management and limiting the chance of self-interested action. However, blockholders also raise concern, particularly about the redistribution of wealth. This could benefit shareholders but harm bondholders, increasing the inherent financial risk for bonds. Now, look at how credit rating impact bonds. Credit ratings are essential for investors because they help assess the risk and return of debt securities, such as bond A high credit rating, such as AA1 or AAA, indicates lower default risk. Naturally, this rating attracts risk-averse investors who prefer stability and security, though they are often associated with lower yields. Lower rate bonds, which carry a higher risk of default, are appealing to risk-seeking investors. These investors are willing to accept higher risk in exchange for higher returns. This is what makes the bond market dynamic. Investors can choose bonds based on their desired risk return and profile. In the Malaysian market, there is a wide range of bonds available, including Sukuk, Islamic bonds, fixed interest bonds, and asset-backed securities. The Malaysian government has played an instrumental role in making the country one of the preferred destinations for bond investors in Asia. Over the years, the regulation of credit rating agency has evolved, with one notable change being the removal of the minimum bond rating requirement of BBB and above in 2000. Despite these regulatory changes, credit rating remain an integral part of the bond market, both for investors and issuers.
My name is Nur Alia Kristina binti Asri. My matrix number is 070066. My part is about credit ratings is important to investor. Investor very concerned with the credit rating issue because it helps the investor measure their risk of default. A higher credit rating indicates lower risk that make the investment more attractive, while lower credit ratings indicate higher risk. This higher risk usually comes with greater potential returns but contains higher volatility. These ratings influence the value of bonds and interest rate at which affect the investment decision with portfolio risk management. For example, in this article, decline in expected cash flow tend to increase the default risk. As a result, bondholder will face larger default risk if blockholder influence the manager to commence in more risky investment that increase uncertainty of firm future cash flow. As the riskiness of its future cash flow or higher probability firm's future cash flow shift downward or default risk increases, hence it may lower the credit rating. Next, we move further to the real consequences of credit rating issue. Corporate credit rating refer to the evaluating company credit worthiness and ability to pay its debt. So in this article, credit rating or known as bond rating is the term used by the investor to identify the relative risk involved when investing in bond. In terms of market volatility, the article highlights that low credit rating cause higher amount of uncertainty in the market. This is because low credit ratings usually experience more price fluctuation in stocks and bond value, as investors may assume that these firms contain high risk. Thus, enhanced in volatility can compromise investor confidence to invest in the firms and affect the company's ability to raise capital that led to financial instability. Last but not least, in this part, there are also circumstances in terms of borrowing costs. The article showed that issuers with lower credit ratings will charge higher interest rate on bonds. This is because investors assume this company riskier, which demand premium compensation in case of default. As an impact, these issuers end up have to pay more to raise funds in the market, which cause long-term financial burden. Thank you. I will pass to the next presenter.
Assalamualaikum. My name is Nur Ella Shafika binti Shah. My matric number is 0718 and 17. Now, let's move to my part, which is finding. Okay, what I can find in this article is corporate governance practices and bond rating in Malaysian local banks. That subtitle and analysis by Josephine Yao Tan Huang, Audrey Liwan, Jeram Kweh Sui Hui, Nur Zaimah Ubaidillah, and Rosita Hamdan and Jessica. It from University Malaysia, Sarawak, UMS. Okay, overview for this article is investigation into how corporate governance practices influence bond rating in Malaysian local banks. And the objective is to determine the relationship between institutional ownership, independent directorship, and bond ratings. And the context is focused on Malaysian banking sector from 2005 to 2017. Now we move to key finding that we have to. Number one is independent directorship and blockholder that show SHB an insignificant relationship with bond ratings. And for firm size, strong positive correlation with bond ratings, and large bank typically have higher bond ratings. And now we move to comparison with previous research that we have two. That number one is Bodraj and Sengupta 2003 that show a positive correlation with outside directorship and bond ratings, and other one is Nanka Bruce that 2011 that show that support positive correlation findings. And now we move to implication part. Okay, what impact for investor? So, impact to investor is firm size is more crucial than corporate governance practices like board independence and blockholder ownership when assessing bond investment. And what impact for legislator? So it is important of considering firm size in policy making for financial stability. And last, what impact to bank management? It is a strategic focus on increasing firm size to improve bond ratings. And the last is conclusion of finding is what we can find in this article. The main is business size has a significant positive impact on bond ratings, and independent directorship and blockholder have a minimal relationship with bond ratings. And foreign contribution provide insight into the factor influencing bond rating in emerging market, and emphasize the relevance of firm size over traditional corporate governance measure in the Malaysian banking context. That's all from me. Thank you.
Thank you, Yaya, for your explanation. So next, I will explain about discussion. Introduction. Bond ratings assess a bank creditworthiness. In Malaysia, bank negara strict rules make governance, firm size, and leverage work differently than in global markets. Governance in Malaysia banks. In Malaysia, independent directors have little impact on bond ratings. Unlike global markets, bank negara strong oversight ensure credit stability without heavy reliance on governance. So next, firm size and bond ratings. Firm size is the biggest factor in bond ratings. Larger banks are more efficient, better at managing risk, and have stronger reputations, leading to higher ratings and investor trust. Then, leverage and bond ratings. Leverage, or the debt to equity ratio, has little effect on bond ratings in Malaysia. Banks follow strict credit standards, keeping debt level healthy and stable. Subsequently, comparative view. Globally, governance matters more for bond ratings. In Malaysia, strict regulation take priority over governance, ensuring financial stability through external oversight. After that, policy implications. What does this mean for policymakers? First, focus on firm size for credit risk. Second, improve governance beyond directors and shareholders. Lastly, maintain Malaysia's strong regulatory framework for stability. And then the last one, conclusion. In summary, firm size is key to bond ratings, while governance and leverage are less important due to strict regulation. Policymakers should prioritize firm size and better governance metrics to ensure stability. That's all from me, and next I will give to the next presenter.
Assalamualaikum, my name is Aisa binti Zaini. My metric number is 071702. In conclusion, the analysis reveals three important insights. First, corporate governance mechanisms such as independent directorship and blockholder ownership show minimal influence on bond ratings. Second, firm size stand out as the most critical factor driving higher credit ratings, primarily due to its contributions to efficiency, risk management, and operational stability. Lastly, Malaysia's regulatory framework with strict monitoring by Bank Negara Malaysia and collaboration with RAM and MARC plays a significant role in shaping governance dynamics. This finding emphasizes the importance of firm-specific characteristics and a strong regulatory environment in determining creditworthiness. Based on these conclusions, I recommend three key actions. First, policy enhancement should include expanding governance evaluation metrics to focus on risk management, transparency, and stakeholder engagement, ensuring they are aligned with evolving market requirements. Second, institutions should leverage firm size to enhance operational efficiency, diversify risk, and improve credit ratings. Third, investors should prioritize firm size and operational stability when evaluating bonds, as these are the main determinants of creditworthiness. By adopting these recommendations, we can foster a more resilient and transparent credit rating system that benefits all stakeholders.